So we're going to be talking about support and resistance and how you can actually use it in your trading. Now, support and resistance is key to building a strategy that's based on technical analysis. Knowing how to properly use support and resistance can be the difference between a profitable and a losing trading strategy. Because we want to give ourselves the highest probability of success with our strategy, to do this, we're going to need to use the strongest and most effective levels of support and resistance. And when it comes to support and resistance, I prefer to draw my levels on either the weekly or the daily chart, and then I'll look for entries on lower time frames. But that's just how I prefer to trade. So depending on which time frame you're taking your trades on, will determine which time frames you should use to draw your support and resistance levels. So for example, if I'm taking trades on the 5-minute time frame, this is the 5-minute time frame right now, I could still have my major support and resistance levels drawn on the daily chart, but most of my trades will probably be taken off support and resistance levels that are on the 1-hour or the 4-hour chart. This is because when you're taking trades on lower time frames, the trades are a lot smaller, your stop losses are also a lot smaller, and your targets are smaller targets. So you'd want to be trading off these levels where you can get smaller moves in the market rather than trading off the daily time frame, which would usually result in larger moves in the market and more volatility at those levels. So back to the daily chart. We'll start with a clean chart, and we're looking for the most relevant levels that the market is likely to react to. So the most obvious level is this resistance level over here. The market tested this resistance at this point here. It traded back down. It came up again and tested this level twice actually in quick succession. And then we traded all the way down till here. And when the market came back, we have this huge rejection candle again at the same resistance level, and then the market traded down again. Now, I personally prefer to draw my levels at big swings in the market, meaning areas that resulted in a huge market move. It doesn't really matter to me if the area has only been tested once. For example, this area here in the market, we only had this support area here. We only actually had one test in the market. After the market gapped over here and reopened here, we had this support area here. So even if this is only just one swing in the market, one test in the market, if the market was to trade all the way down to this level, I would potentially look for some buys around here. The reason I like to trade off big swings is because a big swing indicates to me that there's a huge amount of buyers who entered the market at this level, and they could likely enter the market again depending how this level is tested again in the future. So you can decide to trade support and resistance however you feel comfortable. If you want to trade off minor swings instead of looking for major swings in the market, for example, this area here could be considered a minor swing because it was tested here, and then the market came back, and now it's testing it again. We just had this big bearish engulfing candle that rejected off this resistance level. So if you want to trade off minor swings, that's up to you. You can create a strategy around that. But my personal preference and what has worked for me has been trading off major swings in the market. I would prefer to look at these minor levels as areas for potential profit targets. This is because I only want to take trades off the strongest levels. Although when it comes to targets, I'm looking for any level that the market may have a potential reaction of, even if the level is just a minor level. Minor levels usually only result in pauses in the market as opposed to reversals, but if there is a pause in the market and I'm already in some decent profit, then I no longer want to be in that trade. Multiple tests of a support and resistance zone can also be a good area to place a trade, but that depends. So it will depend on how the level was tested and if the momentum is increasing or decreasing. A simple way to know whether the momentum is increasing or decreasing is to look at the swings that are testing that level. So for example, let's say this market traded up till here and tested this level, this resistance level, and then it pulled back until here, and then it traded back up, tested it again, and then it pulled back till here, and then traded back up and tested this resistance level again. That would indicate to me that there is a loss of selling momentum. This market would be losing momentum because each test in the market is resulting in a reduction in selling pressure. So other than the first test, which pulled back until this level and tested again, every test that the market would have of this resistance level has less selling pressure. So first, the market tested this level here and resulted in this huge swing. We pulled all the way down until here. With the next test of resistance, they pushed the price back down again, but this time not as far down as the first time, meaning there were not as many sellers at this resistance level as they were at the first test. And with the third test over here, you'd see the market losing even more momentum as the sellers are unable to push the price any further down. This would indicate to me that the momentum is fading and the buyers could be stepping in. And in this situation, I would be looking for potential buys in the market. So a market would be gaining momentum if the opposite happened. I'll show you an example of what I mean on this chart. We're now on the Euro British Pound daily chart, and we have this previous support area, now potential resistance right over here. So as you can see, there was a huge swing over here. The market came close to testing it here, but we tested this level over here again, which resulted in another swing, and then eventually the market broke through with a lot of bearish momentum, and now we are retesting the same area as potential resistance. So if the market was to trade down till here and then trade back up again and test this resistance zone again, and then trade it down until here and then trade it back up again, this to me would indicate an increase of selling momentum now. This is because with each test of this resistance, there'd be an increase in sellers coming in the market. Every time the resistance is tested, the sellers push the market further down. So if the market was to come and test at this point, I would potentially be looking for a sell, but that would depend completely on the makeup of the candles and some other relevant factors. I only use support and resistance zones that are relevant at the present time. And what I mean by that is, if I go back historically, if we look back, we can see that there are some areas that the market respected in the past. If we look at this area here, for example, the market respected it here. We found some support here. We found support again over here. And then we found support a third time. The market broke through, came back up, retested again, traded all the way up here, came back, respected this zone again. But at the moment, I wouldn't be looking to place trades off this area, because based on the last few interactions the market had with this zone, it doesn't seem like this zone is relevant anymore. I don't see a point keeping a zone that historically was a very strong level when the market doesn't respect that level anymore. You want to use levels that are currently the strongest levels for your trading. As a general rule, I'll remove a support and resistance area once the market has not reacted to that level twice. So what I mean by that is, for example, here, when the market tested this support level twice, here, over here, and over here, but then it broke through and there was no reaction at this level. So if this market had to trade straight back up and there was no reaction at this previous support, now potential resistance area again, then I'd no longer be interested in looking for trades at this area, because it would seem that the market is not respecting this level anymore. It's also important that your support and resistance levels are placed as zones and not just a single line. This means that the level should be an area. That's why I like to use this rectangular tool, so I can plot my levels as a complete area as opposed to just one single line. You'll hardly find that support and resistance will test a specific point, and therefore you shouldn't be looking to trade from a specific point. Rather, you should be looking to trade at an area in the market where all your reasons for entry are met, and then you can enter the trade. I really hope this video helped. Please leave a comment if you have any questions. Like the video if you enjoyed it. And I drop new videos every week, so subscribe to the channel so that you don't miss any of them. Thanks for watching.